Welcome to the Deep Dive. Today, we're tackling a pretty big question. Is the era of, automatic U.S. economic dominance
Yeah. Mhm.
maybe coming to an end?
It feels like a turning point, doesn't it?
It really does. We've got a fascinating collection of insights here, everything from recent market movements, the growing pile of U.S. debt, the twists in terms of trade talks.
How consumers are feeling, what big companies are doing.
Exactly. Our goal for you, the listener, is to get a clear view of this shifting landscape, understand the real drivers behind these changes, and sort of pinpoint what you should be watching closely without getting bogged down in jargon.
Let's get into it. It's a critical moment, really. We're seeing several powerful forces converging,
Hmm.
making people rethink some pretty fundamental assumptions.
Especially that big one, right? The long-held belief that the U.S. market will just always outperform.
Always, yeah.
Exactly. And it wasn't that long ago, like end of 2024, the story felt pretty straightforward. You had a new administration, focus on growth, big tech seemed unstoppable.
Right. U.S. stocks were the place to be. It felt almost like a sure thing.
Yeah, that conviction was, is widespread.
But fast forward to now, and the reality looks quite different. The S&P 500 barely budged this year after some ups and downs. Meanwhile, you look at Europe, Italy, Germany, even Poland showing some really significant gains. We're talking 20-odd%, maybe more.
Wow.
And suddenly, funds that specifically exclude U.S. stocks, they're attracting a lot of interest.
That's a real about face, isn't it? It really sounds like investors are starting to maybe seriously doubt the old playbook.
Precisely. You hear reports like from Goldman Sachs Asset Management. Their clients are asking, has the U.S. good trade run its course? And some are actually acting on it, putting on hedges basically, insurance against potential drops in U.S. stocks or a weakening dollar.
So it's not just talk.
No, it's tangible. It's a shift in how people are positioning their money.
And this isn't just like a sudden feeling, is it? There's some deeper analysis suggesting maybe this shift has been building for a while.
Absolutely. There's a recent paper from AQR Capital Management. It suggests that this whole idea of U.S. exceptionalism might have been, well, maybe more hope than reality.
More hope than reality.
Yeah.
How so?
They argue that a big chunk of the U.S. outperformance wasn't just faster growth, but more about valuations going up, how much investors were willing to pay for each dollar of earnings.
So the price tag got inflated.
Exactly. Inflated prices may be more than truly superior performance.
Yeah.
And it's easy to forget, right? The U.S. has underperformed before. Think the 2000s, the 80s, even the 70s.
Right, we forget those periods.
We do. So this belief in constant U.S. dominance, maybe it wasn't grounded in the long-term data.
That's a key point. We got so used to hearing about the U.S. entrepreneurial spirit, the market-friendly system, that leading to stronger growth.
And those things matter, definitely. But AQR points out, while earnings were good, the prices investors paid, they went up even more. Think about index funds pouring money into the biggest stocks.
Automatically, yeah.
Active investors favoring big tech, momentum trading, it all just pushed those valuations higher and higher.
To the point where, U.S. big tech was worth more than the entire European market?
By the end of last year, yeah. Mind-blowing, isn't it?
It really is. So we went from, say, U.S. stocks being worth half the rest of the world back in the late 80s.
To almost twice as large by the end of last year. That kind of extreme relative valuation, well, it raises questions.
Yeah, doesn't sound sustainable.
The AQR paper puts it pretty bluntly. They ask, should investors in 2025 worry about the historically extreme relative U.S. valuation? And their answer?
Let me guess.
A clear yes. The worry is that maybe investors confuse those soaring stock prices with some kind of fundamental, unshakable superiority.
Okay, so what could actually trigger a change? What are the big risks we should be keeping an eye on?
Well, one risk is simply complacency, just assuming things will stay the same. One source called that complacent, arrogant even. Then you have things like maybe chaotic economic policy, challenges to institutions. Even look at China's progress in AI, like with DeepSeek.
Right, that protective mode around U.S. big tech might not be as wide or deep as people thought.
Exactly. It feels like investors are now caught between, their recent experience of strong U.S. returns.
And the longer-term historical patterns. Stories versus statistics.
Well put. And the fact that more fund managers are talking about managing risk, that suggests maybe the American exceptionalism fever, as they put it, is breaking.
Okay, that's a lot on the market side. Let's shift gears a bit. Another critical piece. The growing U.S. national debt.
Yeah, this keeps bubbling up, and Moody's actually lowered their rating on U.S. debt recently.
Not a good sign. Why did they do that?
Citing concerns about the debt level, obviously, but also government spending patterns.
And some big names are sounding the alarm too, right?
Yeah. Oh, definitely. Ray Dalio offered a very stark take. He sees this mountain of debt, the appetite for more spending. He thinks it's a critical issue. He even mentioned a potential debt crisis within, say, 3 years or so.
3 years, wow. And part of the problem is finding buyers for all this debt.
That's a growing concern, yes. Finding enough willing buyers. And trade wars don't exactly fit that situation.
Right, because more debt usually means higher interest rates,
Right.
like needing to offer a better deal to lenders.
Precisely. Which then puts more pressure back on the economy. Think higher borrowing cost for everyone. Dalio even floated the very serious possibility of the U.S. needing to restructure its debt down the line.
Restructure, that sounds serious.
It is. And he also criticized the rating agencies a bit, said they don't fully capture the inflation risk if the government just prints money to cover debts. That erodes the value for bondholders.
And this debt problem isn't exactly shrinking, is it? The recent tax bill I remember reading is projected to add trillions more.
Trillions. Yeah. Estimates range from $3 to $5 trillion. And like we said, that typically forces investors to demand higher returns, higher treasury yields.
We've seen that happen already, haven't we? The 30-year treasury yield went above 5%.
It did, and the 10-year hit its highest point since February. When bond yields rise like that, it makes stocks look less attractive by comparison. Why take the risk on stocks if you can get a decent, safer return on bonds?
Okay, so we've got potential market underperformance, growing debt worries. It really feels like the ground is shifting. And then there's the whole trade situation with China. That's still ongoing, right?
Oh, very much so. It's incredibly complex. China has definitely responded to those big U.S. tariff hikes, somewhere up to, 145%?
Yeah, huge numbers.
So China's response included cutting interest rates, trying to boost their own economy, reducing bank reserve requirements to free up lending.
Trying to cushion the blow.
Right, and funding factory upgrades, service businesses. But they also hit back with their own tariffs on U.S. goods, up to 125%, and pretty much stopped buying most U.S. farm products.
Ouch. But despite all that friction, there are actually talks planned in Geneva.
Yes, talks are scheduled. Secretary Besant, USTR Greer, Chinese Vice Premier He Lifeng. Interestingly, China made a point of saying the meeting was at the U.S.'s request.
But it sounds like, publicly at least, neither side is really signaling compromise on the tariffs.
Not really. Both sides seem pretty adamant, publicly anyway. China's warned against pressure or coercion.
It feels like China's stimulus measures could almost be seen as strengthening their position before these talks, a policy buffer.
That's certainly one interpretation. ANZ Research used that term, policy buffer, suggesting China's preparing for what they expect to be a protracted negotiation. The feeling is China will hold a pretty strong line against protectionism.
We saw that initial rush, didn't we? Companies scrambling to ship goods before tariffs hit. But now, it seems like both economies are feeling the strain.
Yeah, that initial rush is over. The U.S. actually saw a small economic contraction in the first quarter, remember, minus 0.3%. And while China reported 5.4% growth for Q1, some economists are skeptical. More recent data suggests weakening export orders, lower business sentiment over there.
So, these talks in Switzerland, an opportunity? Maybe, but probably not a magic bullet.
That seems to be the consensus. Morgan Stanley called it an opportunity to maybe reduce some tariffs, but felt a durable resolution remains elusive. Too many underlying issues. And remember, those really high 145% threatened tariffs got reduced, but they're still significant, with some higher ones just paused.
Okay. All this uncertainty, markets, debt, trade, it has to be weighing on people, on consumers. Let's talk about consumer sentiment. That feels really key right now.
It absolutely is. Doug Ramsey over at the Leuthold Group warned about a potential self-fulfilling confidence collapse.
Ooh, that sounds bad. What's driving that concern?
He's looking at key indicators. The Consumer Expectations Index from the Conference Board dropped to its gloomiest level since 2011 in April, way below the level that usually signals a recession.
Okay, so expectations are low. What else?
People's expectations for inflation over the next year, they've jumped up again. University of Michigan survey showed 5%. And the number of people expecting unemployment to rise in the next year, that's climbed for 5 straight months, more than doubled since last November.
So less optimistic about the future, expecting higher prices, worrying more about jobs. How does that translate into, real economic impact?
Well, when people feel less confident, they tend to pull back on spending, right?
Yep.
And that drop in demand can really slow things down. Ramsey estimated that just the recent fall in expectations could push real GDP growth down from around 3% to essentially zero.
Zero growth, wow.
Yeah.
He called it not merely self-fulfilling, but self-inflicted as well.
Yeah, a stark warning. And seeing that small GDP contraction in Q1 just adds to the worry, raises the possibility of a technical recession, you know, 2 negative quarters in a row.
Yet, some data still looks okay. I thought the Atlanta Fed was still forecasting decent growth for this quarter, and unemployment's still low.
That's the confusing part. You've got some backward-looking data, like the unemployment rate at 4.2% in April, still near historic lows, and that Atlanta Fed GDP Now forecast still projecting growth, around 2.4% last I checked.
So a real disconnect. Healthy-ish rearview mirror, but the windshield looks foggy.
That's a good way to put it. This divergence between the hard data we have and these softer, forward-looking sentiment indicators creates a lot of uncertainty about where things are really heading.
Okay, and how are businesses reacting? Are the big companies echoing these concerns?
They are, yeah. We heard warnings from both Walmart and Target about potential price increases because of tariffs.
Right, Walmart mentioned car seats, I think. A $100 increase.
Specifically, yeah, Chinese-made car seats. And Target, well, they reported a sales slump in Q1, missed expectations. They actually cut their forecast for the whole year.
Ouch. What do they blame it on?
Their CEO pointed directly to the highly challenging environment, mentioning tariff uncertainty and declining consumer confidence.
And Target had some other headaches too, didn't they? Something about boycotts.
Yes, that's true. They faced customer backlash related to changes in their DEI, diversity, equity, and inclusion approach. That definitely contributed to the sales dip, too. Shows how these things can intersect.
Then you have Jamie Dimon, CEO of JP Morgan Chase, flagging the risk of stagflation.
Right. Stagflation, that tricky combination of slow growth and high inflation. He pointed to geopolitical tensions, price pressures, government deficits.
Does he think the Fed is handling it okay?
He said he thinks the Fed is approaching it correctly, being data dependent, but he also said he doesn't see a sweet spot where everything just works out perfectly. He also really emphasized the need for certainty around tax and spending and dealing with the deficit problem.
But not everyone agrees on stagflation, right? Some point to inflation cooling slightly, other positive signs.
Correct. Some argue the data doesn't fully support the stagflation camp yet. They point to headline inflation easing a bit, producer prices falling, maybe surprisingly strong retail sales, stable jobless claims, signs of resilience.
So mixed signals again. But the caution from big players like Walmart, Target, Jamie Dimon, that carries weight.
It definitely does. Businesses seem to be hedging their bets, remaining cautious despite some pockets of strength.
Okay, so with all these shifts, all this uncertainty, how is the investment world actually responding? Are people really looking elsewhere besides the U.S.?
Absolutely. That debate, U.S. versus, say, Europe, is really heating up. Fidelity Answers discussed this recently. The argument for the U.S. still exists, potential for political consensus on change, maybe an investment surge as capital gets deployed, still the best demographics among developed nations for long-term growth.
But more bumps in the road near term.
That's the expectation. More volatility, especially if the U.S. is trying to transition to a new economic model, maybe less reliance on outsourcing. There's uncertainty about the costs and competitiveness of bringing production back home.
Okay, so what's the case for Europe then?
Well, interestingly, the tariffs making life harder for European companies selling into the U.S., that could actually spur more growth within Europe.
Oh, interesting. Like forcing them to focus domestically.
Potentially. Maybe leading to the emergence of European national champions that can compete globally. So the focus is shifting a bit towards domestic European players. Think banks, airlines, travel, and sectors less hit by tariffs, like software.
But sectors like capital goods, autos, they might need to invest more in the U.S. to sell there.
That's the thinking, yeah. Adapt or potentially lose market share. It's a significant potential shift.
And what about emerging markets? Are they getting more attention in this sell U.S. narrative?
They definitely are, especially after that Moody's downgrade of U.S. debt. You see analysts at places like Bank of America, JP Morgan, highlighting opportunities there.
Why emerging markets specifically?
Several factors. A potentially weaker U.S. dollar makes their assets cheaper. U.S. bond yields might have peaked, which is good for emerging market borrowing. There's potential for a China recovery eventually. And generally, valuations look more attractive compared to the U.S. right now. That erosion of confidence in U.S. assets is definitely fueling interest elsewhere.
Okay, one last area to touch on briefly. The role of non-bank financial institutions, NBFIs. How do they fit into this whole changing picture?
It's an important angle. Sometimes just looking at traditional categories, banks, insurance companies, doesn't give you the full picture of how finance actually works today.
So look at the function instead of the entity.
Exactly. A functional perspective looking at what economic roles are being played, like providing safe assets, managing incentives, facilitating lending that's increasingly relevant. NBFIs often fill specific niches. They can compete with banks or sometimes cooperate with them.
Can you give us a quick example?
Sure. Think about securitization, bundling mortgages or other loans into securities sold to investors. That's often done by SPVs, special purpose vehicles. That's an NBFI creating relatively safe assets by pooling risk.
Okay. Different from, say, a mutual fund.
Right, which relies more on being able to sell assets quickly if people want their money back. Which strategy is better can depend on the kind of economic uncertainty we're facing.
In cooperation, you mentioned cooperation with banks.
Yeah, think about private credit firms. Sometimes banks find it too costly or risky to lend to certain borrowers, so a bank might lend money to a private credit firm, an NBFI, which then lends it out to those riskier borrowers, usually at a higher rate. This kind of cooperation seems to happen more when interest rates are generally higher.
Fascinating. Adds another layer of complexity.
It really does.
Okay, so let's try and wrap this up. We're seeing a real challenge, it seems, to that old assumption of automatic U.S. market dominance. Europe showing surprising strength.
Definitely.
The rising U.S. debt and that Moody's downgrade are, well, serious concerns causing nervousness.
Can't ignore those.
Tariffs are creating headwinds, leading to these uncertain trade talks. Consumer confidence is shaky, raising slowdown fears, even if some data still looks okay on the surface.
A very mixed picture there.
Big companies are cautious, warning about prices, adjusting forecasts. And investors, they're actively debating U.S. versus the world, with Europe and emerging markets gaining attention.
The investment landscape is definitely shifting.
And underlying all that, you have the evolving role of these non-bank financial institutions adding complexity.
Exactly. All these factors are interconnected, interacting in ways that make this a really critical and frankly uncertain period to navigate.
So here's a final thought for you, our listener, to maybe chew on. Given all these converging factors, this potential end of U.S. market exceptionalism, the sheer weight of the national debt, the unpredictable fallout from tariffs, how might your own financial strategies, your own outlook need to adapt to navigate this shifting global economic landscape? What new signals, what new indicators will you be watching most closely as we move forward? Thanks for joining us for this deep dive.